Hello, I'm Kevin Miller, the CEO of the E-Valuator. The purpose of this presentation is to go through the rules-based functionality of the software, how the two dials create 4 different investment zones, and how we simplify the complicated for the advisor as well as for the client. First, the rules-based functionality. Step 1 is the system will allow the advisor to determine what an acceptable performance level is for each investment relative to its Morningstar peer group. Secondly, it'll identify what is an unacceptable performance level for each investment relative to its Morningstar peer group. Thirdly, it'll establish a duration tolerance. The duration tolerance is the period, the number of months that an investor or an advisor is willing to accept lagging performance out of an investment until replacement is warranted. And then lastly, timeframes. What timeframes are we going to use in this analysis? Is this investor going to be more short-term focused or more long-term focused? So if we get started, we look at the two dials that are the first 2 components of the system. We have a keep dial and we have a replacement dial. The keep dial identifies what is acceptable. The replacement dial identifies what is unacceptable. The keep dial can be set from anywhere from 0 to a positive 50%. If it's set at 20%, as you see here, what that tells us is that this advisor is saying that they want their investments to outperform the average of that investment's peer group by 20%. So if the peer group's average return is 10%, positive 10, 20% of 10 is 2, we would want a 12% return in that environment. So the higher the keep dial is set, the more difficult it is for investments to meet or exceed that performance. The lower the keep dial is set, the more passive in nature that investment's management would be. If we look at the alternative side of this, the replacement dial, if that is set at minus 15%, that means that this advisor and investor is willing to allow their investment to lag the average of the peers by 15% before replacement is warranted. Again, in an environment where the category average is at 10%, minus 15 times 10 is minus 1.5. 10 minus 1.5. What this is saying is that in an environment where the average is 10, the investor would allow their investment to go as low as 8.5% before they would start anticipating that replacement would be warranted. If an investment does go below 8.5%, then we look at the duration tolerance. How long would we allow an investment to underperform the average of its peers before replacement was warranted? E-Valuator software allows anywhere from 1 to 15 months. In this example, this advisor, this client, has established a 6-month duration tolerance. So if an investment is lagging the average of its peers by 15% or more for 6 months, then replacement is warranted. Lastly, we look at timeframes. E-Valuator downloads over 35,000 mutual funds and ETFs, the data, the performance data on them every night. It downloads the 1-month, 3-month, 6-month, and 1 through 10-year returns. The checkbox indicates that the time frames have been selected. If there's a box that is not checked, then that time frame just isn't included in the analysis. The number behind each checkbox identifies the weighting or the influence that time frame has on the analysis. We call these performance credits. The performance credits always total up to 100. So in this example, the 5-year time frame influences the analysis by 20%, where the 1-month time frame only influences the analysis by 6%. So this would be a more longer term focus and little to no focus on short term. The two dials create 4 zones. Dark green is solid keep, Light green is above average, it's doing well, but it's not doing as well as the standards would demand. Yellow would be below average, meaning it's lagging, but it's not to the level where the standards have suggested a replacement. And then red would obviously be the replacement zone. The evaluator also has a criteria screening control. There's about 35 different ways investments can be screened. First, they could be screened on their performance ranking. Here we're saying we want to see the 1 year, 3 year, and 5 year performance ranking in the top 50th percentile. These numbers indicate the number of investments that pass that criteria. Then we can screen based on standard deviation and beta, 1 year, 3 year, 5 year for each, and it's just a simple click as far as determining at what level of criteria you want this filter to function. Next, you have the Sharpe ratio and alpha, again 1, 3, and 5 year, and then next you have the downside and upside capture ratio, 1, 3, 5 year, and then lastly toward the bottom you have things like expense ratio, turnover ratio, management tenure, size of the fund, 12B1s. You can sort just for mutual funds or just ETFs. In this example, we're sorting both mutual funds and ETFs, which at the time of this, there's over 37,000 of them. Once the screening has been done, the evaluator software will go into the category, and based on the settings and the time frame selected, it'll assign a score. And remember I said those credits equal 100. So it'll sort the investments from highest score to lowest score, this column right here. This happens to be the high yield bond category. So you could see, you could easily just come in and say, hey, these are some of the best high yield bond funds at the time of this illustration. And at that point, you could select one of these funds. You could check on the eyeball, and it would pull up the data on this fund so you could analyze it before you made that selection. Or you could click on the expense ratio header and sort them from lowest cost to highest cost. Obviously, you can see the top investment here has a relatively low evaluator score, but the second one has a substantially better evaluator score. So potentially, the second investment would be an ideal alternative in the high yield space because it's lower cost and because of its strong performance standards relative to its peers. Here's what the evaluator performance grid looks like. This is a good fund. This is a good investment. On the left, you'll see the time frames that were selected: 1 month, 3 month, 6 month, 1, 2, 3, and 5 years. On the far right, you'll see the month to date column. And then just to the left of the month to date column will be the most recent month end. And then we show you every column going back for every month end for the last 15 months. So every column represents a month. The farthest right column represents the month to date. So this bottom row of colored boxes, that represents the 1 month return of this investment at the end of every month that's listed at the top of the column. The number inside each month, inside each box is the actual performance, in this case, the 1 month return. The color of that box tells you whether that performance exceeded the top dial or so the dark green means that it was exceeding the top dial settings. In this case, these returns are more than 20% above the average of the peers. This light green box, that indicates that even though it's a minus 2.24%, that the return was above average, but it wasn't more than 20% above average. There are a couple yellow boxes here. That tells us that the 1 month returns for these month ends was below average, but it wasn't more than 15% below average because those boxes aren't red. You can total this up across the bottom. You can see month by month the total score. There's a couple months where this fund was perfect, 100 out of 100. You can see that on a month by month basis, it's a solid keep. This down here shows you the 6 month trend, and you can see that it's a very strong performing fund. This investment, on the other hand, is not a good investment. When you see red, it's not good. The 6-month, 1 year, 2 year, 3 year, and 5 year returns of this investment have consistently been more than 15% below the average of the peers. You can see down here that this investment's been on solid replace continually. There have been times where one point I should make is if an investment is on replace, it earns no credit. So the 1 month return for this month was 1%, minus 1%. That earns 0 credits. So when you total up the credits, if every time frame this investment was lagging the average of its peers by more than 15%, it would have earned 0 credits. That's why you're seeing just a dashed line in here. You can also see that the 6-month trend is very poor. So these are extreme cases, but we just wanted to show you the extreme difference between the two so you could see how easy it is, how we are simplifying the complicated. All you have to do is look at the performance grid and you can quickly discern a good investment from a bad investment. This also shows investments that are improving, trending up. The reason we look at 1 month, 3 month, 6 month is because what's happening in the short term, if that is sustainable, it will permeate up into 6 month, 1 year, and 2 year. And that's what we're seeing here. It's like a business. If you have 3 good months, you're probably going to have a good quarter. You have some good quarters, it's going to improve your 6 months. You have some good 6 months, it's going to improve your 1 year. You can see what it's done to the trending down here, the 6-month trend. We've got solid green arrows going up, meaning things are getting better. This investment, on the other hand, is actually trending down. You can see how the red is going up the time frames, 3 months, 6 months, 1 year, and 2 year, and the 3 years now starting to get pulled below average. If you look at the 6-month trend of this investment, you can see that is also going in the wrong direction. So the tool makes it very easy for clients and advisors to be able to see whether investments are instantaneously good, instantaneously bad, or if they're trending in one substantial direction or the other. There's about 1,500 calculations going on inside each one of these performance grids. To make this a little bit easier to comprehend, we created the bubble chart. So across the bottom, you see the tickers in this fund, in this portfolio. You see whether they're trending up, down, reversal, positive or negative, etc. Directly above each ticker symbol, you see a bubble, a color-coordinated bubble. Where that bubble is located tells you whether this investment is a solid keep, like this one, or if it's a replace, like this one, or if it's in the watch zone, whether it's above average or below average. The size of the bubble denotes that there's more money in this investment than there is in this one. So very quickly, a client can see that that performance grid has compiled all those 1,500 calculations and pinpointed where this investment is relative to its peers based on the settings that have been created by the system. In this example, this portfolio has about 29% of the assets on replace, 7% below average, 8% above average, and 54% would be in solid keep. This would be an excellent candidate to take over as an advisor. If you're looking at someone else's account and their account looks like this, you could show them instantaneously how you could improve the performance of each of these categories where these investments reside. Let's talk about the reports menu. There's a significant number of reports that can be selected. You would just want to pinpoint what reports you want, the dashboard, the bubble chart, portfolio composite, etc. You can also select individual investment reports. You can select the alternative or replacement investments for the one that is currently being used. The system also feeds into the investment policy, so it could select that you want it to print the investment policy, and you could also print the underlying benchmark averages, which are the Morningstar categories. Not all of these, but most of these investments have been reviewed by FINRA. Once you've selected which investments you want to offer, then we have an automated statement processing service where step number 1 is you'll select the frequency that the PDF is going to be sent to the client. whether it's monthly, quarterly, semi-annual, or annual. In this case, they selected monthly. Step 2 is you pick what day of the month that is going to be sent. The earliest you can select is the 10th day of the month, but you can pick whatever day. In this example, they picked the 20th. And then you can select who the email is supposed to be sent to. You can send it directly to the client, you can send it to yourself as the advisor, or you could send it to additional recipients. Or you could click all of them. And maybe you wanted the client has 2 email addresses, so you send it to the one that's on file, and then you type the other one in down here as well. So now that you've selected the package of reports, you've selected in this case, the month, the date, and who to send it to, the system will automatically send those reports to the client based on this frequency, on this date, without any time involvement from the advisor or their staff. Lastly, the last major feature that this tool has is the ability to compare portfolios. It can compare up to 4 portfolios. We're just showing 2 at this time. It does a risk assessment to discern from a 0 to 100 what the risk structure is of the underlying investments. It compares standard deviation, downside capture, upside capture, and beta. It shows what each portfolio would have done back in 2002 when the market crashed, or back in 2008 when the market crashed. It also compares performance. It'll look at the expense ratio weighted, it'll look at the weighted turnover ratio, and management tenure. It'll compare annualized returns, performance to cost ratio, Sharpe ratio, alpha, and then to validate that we're comparing apples to apples, it'll show the settings that are in existence in each portfolio's account. What that top dial setting is, what the bottom dial setting is, what the duration tolerance is, and what the credit attribution is. Lastly, it'll show you the bubble charts for each portfolio. So if you were to walk into a prospect, you'd take their ticker symbols, you'd put the amount of money dedicated to each ticker, you'd load that into your E-Valuator software, you'd put the portfolio you'd recommend, and then you'd be able to easily compare what they have to what you can deliver, and I'm guessing that the difference will be substantial in your favor. That's all we have today. Thank you for taking the time to listen to the brief introduction and overview of our software. Feel free to reach out to us, and if you have any questions or would like a demo presented on the behalf of your firm. Thank you very much.